Hey everyone, it's Alan back again with another video, and today we're continuing a video series on my channel in which we're taking a deep look into each of the current top 5 highest yielding Dividend Aristocrat stocks out there. Last week I made a video in which I introduced each of the top 5 highest yielding aristocrats, and today we're taking a look at number 5 on that list, which happens to be the Chevron Corporation. For those of you who might not be familiar, a Dividend Aristocrat is a stock that has a history of consistently growing its dividend over a long period of time. In order to qualify as an aristocrat, a company must consistently increase their dividend for at least 25 consecutive years, as well as be a part of the S&P 500. Being known as a dividend aristocrat carries a lot of prestige for a company, as it's not an easy thing to achieve since it takes a minimum of at least 25 years, as well as simply having enough cash on hand to continue to increase their dividends in order to attain that status. Companies that are part of this elite group are often viewed in higher regards by investors as being safer investments, and these stocks are often less volatile than other stocks out there. So while Chevron is in this elite group, and not only that, but they're one of the highest yielding stocks in this group, one of the most important questions we as dividend investors need to ask is how safe is that dividend? Is it sustainable going forward, or is there a risk that a dividend cut might be coming in the near future? Let's go ahead and take a deep look into this company and try to assess what the future holds. So first, let's start with an introduction. Chevron engages in integrated energy, chemicals, and petroleum operations worldwide. The company operates in two segments, upstream and downstream. The upstream segment is involved in the exploration, development, and production of crude oil and natural gas. The downstream segment engages in refining crude oil into petroleum products and also marketing crude oil, refined products and lubricants, transporting crude oil and refined products through pipeline, marine vessel, motor equipment, and rail car. Right now, Chevron is trading at $105.93 per share, with the share price being up over 40% from this time a year ago. It currently pays a quarterly dividend of $1.29 per share, giving it a dividend yield of 4.8%. Chevron has raised its dividend for 33 consecutive years, making them more than qualified to be a dividend aristocrat. In regards to its footprint, Chevron is currently the largest oil company in the United States, just overtaking Exxon back in October. They're the 15th largest company in the United States according to Forbes, with revenue of over $146 billion. They have roughly 48,000 employees in 2020, and as far as their drilling operations, Chevron produces about 3.5 million barrels per day. From an operational perspective, Chevron is considered to be one of the best in regards to operational safety. As you can see from their March investor presentation, Chevron only had one oil spill in all of 2019, compared to roughly 7 being the average for their competitors, including Shell and BP. These numbers make Chevron stand out in how they perform operations-wise from an international perspective. Financially speaking, there are two things in particular that really stand out to me. Chevron has 4 financial-related goals in their latest investor presentation. The number one goal, maintaining and also growing that dividend, which as investors is always great to see. The second item that stood out to me is Chevron's lower debt ratio when compared to their competitors, as you can see by the chart on the right. The debt ratio is a financial ratio that determines how much leverage a company has, and it's calculated by taking a company's total debt and dividing it by their total assets. And while debt ratios will vary across industries, having a lower debt ratio is a good thing in Chevron's case, because the higher the debt ratio, the more financial leverage a company uses, making it a riskier investment. So the fact that Chevron has a lower debt ratio than its competitors means that there's less financial risk to the company. In addition to that, Chevron recently had a major acquisition back in October of 2020 when they acquired Noble Energy, which is an oil and natural gas company with a large footprint in the Eastern Mediterranean. On top of this additional access, the acquisition is expected to save the company roughly $300 million, and in the end will probably save them even more due to the fact that Chevron also acquired the majority of Noble Midstream, which also will help save them even more money down the line. Chevron has also initiated a lot of green energy programs in order to power their operations in a way that's less harmful to the environment. They've invested over $1 billion in order to reduce their carbon emissions, as well as using more wind and solar energy, and they claim that they're hoping to stop routine flaring by 2030. Everyone knows environmentalists have continued to criticize this industry for decades as not being green enough, so maybe programs such as these will at least help their public image. But the bottom line is oil is definitely not going away anytime soon, as the demand is still expected to increase until at least the year 2050, according to the United States Energy Information Administration. You might not realize just how dependent we are on oil for a lot of everyday things. While it's true that motorized vehicles account for the highest amount of oil consumption, oil is used in airplanes, farming equipment, ships, lubricants and greases, and it's also used to manufacture your clothes, electronics, car parts, sunglasses, kitchenware, appliances, and so many other things. This is a pretty interesting graph I found. If you'd like to see this graph for yourself, I'll go ahead and leave a link in the description of the video. You'll be really surprised at just how big of a footprint oil has in our everyday lives. I know news stations like CNBC like to report how electric vehicles are just going to take over the world very soon, but in my opinion, I just don't believe we're going to transition to an all-electric vehicle country or world anytime soon. Unless the government really tries to force it down our throats, I think gas and diesel-powered vehicles are going to stay for decades to come. Not to mention, they'll have to figure out other ways of producing all of those other products I just mentioned. As you can probably imagine, COVID made things really difficult for Chevron as oil production slowed down to a crawl during the worst of the pandemic. The economy slowed down dramatically in 2020 while the world was in quarantine. As a result, in 2020, Chevron posted a loss for the year in their income statement. At first glance, this might naturally cause us to worry. After all, if Chevron reported a loss, how can they afford to keep their dividend? While you might be tempted to believe that, Chevron has one great thing going for them that their competitors don't, and that's a solid balance sheet. Chevron currently has over $5.6 billion worth of cash on hand, which when combined with their available borrowing capacity through its credit facilities, leaves me to believe that Chevron is capable of keeping their dividend should they want to and without running into any more global crises. Wall Street analysts currently list Chevron stock as being a moderate buy, according to tip ranks, with 11 giving it a buy rating and 5 giving it a hold rating. They're predicting a 10.71% upside, with analysts' highest forecast pricing CVX at approximately $130 within the next 12 months. But again, that probably relies pretty heavily on the world continuing to recover from the COVID pandemic. The entire oil industry as a whole is expecting things to increase dramatically once the world fully recovers from the pandemic. Even during the worst of it all, oil consumption remained mostly steady. In a pre-pandemic world, the demand for oil was around 100 million barrels per day according to estimates. That dropped by as much as 20% during the worst of the pandemic, but as of right now, Morgan Stanley thinks the demand will be back above 100 million barrels by later next year, and Goldman Sachs actually believes that we'll be over that 100 million barrel demand mark before the end of 2021. One more thing I figure I'd mention is for those of you who are Warren Buffett fans, Berkshire Hathaway has an estimated $5.3 billion stake in Chevron. That comes out to roughly a 2.5% ownership stake in the company. What's kind of interesting about that, though, is in the past, Warren Buffett actually voiced concern about investing in the oil industry. But apparently he changed his mind and he's now a pretty big shareholder of the company. Alright, that's going to do it for today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and also subscribe to the channel if you want to see more high dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to do my best to keep providing you all with that knowledge. Feel free to let me know your thoughts on Chevron. Are you buying it? Are you avoiding it? Or are you holding onto it for the time being? If you have any other dividend stocks, feel free to let us know in the comments below since we're always on the hunt for the best dividend investments. Okay, thanks again everyone for watching and I'll see you next time. Take care.